Kitco Mining's special coverage of resourcing tomorrow is brought to you by Aris Mining.
The majors are investing in juniors. This is Paul Harris for Kitco Mining at Resourcing Tomorrow in London. Joining me today to discuss this is Michael Gray, partner at Agentis Capital. Michael, welcome to Kitco.
Thank you very much. Pleasure to be here, Paul.
Now, Michael, let's start with who or what is Agentis Capital?
Agentis Capital is a research and advisory firm focused on both infrastructure and mining. We're all formerly with Macquarie Bank, offices in Vancouver, London, Toronto, and in Calcutta. So we provide a independent research product, mining and investment product, similar to what we did at Macquarie. And we focus on best of breed opportunities in the mining space, explore developers and some producers.
Okay, very interesting time to be doing this, I imagine. Gold is threatening to break out at $2,000 US per ounce. Seems to be hopefully forming a floor there. Silver's touching $25. Uranium's obviously had a breakout in recent weeks. Are these price rises going to stick this time?
Yeah, I think on the gold side of things, I think they will. We're looking at gold hanging in there, despite interest rates being very attractive for investors. It's very sticky. We're seeing the inverted 10-year tips versus gold diverge for the first time in the past 6 months. There's a big disconnect. So we think any decrease in interest rates by the Feds will probably be very torquey for gold. I think on silver, very constructive based on its industrial uses. We're pretty happy with the $25 long-term silver price right now using the deflated forward curve. And then certainly copper, in a couple of years, I think there's going to be tremendous demand as the supply side gets a little bit tougher and there's more uptake on the electrification side of things.
Well, the copper price has sort of stuttered or stagnated this year or been in a plateau. Well, why do you think that is?
Well, it's partly the China lack of demand. The housing sector in China has not been as robust, which has consumed a lot of copper. I think the seniors are being a little bit more challenged on their growth projects. QB2 for tech now up to $8 billion in terms of expansion for that or build for that project. I think it's just we're just not seeing the growth right now, and we've got some big copper projects that have come online. So I think there's a little bit of reticence to get constructive on copper for a few years, maybe.
Evie Hambro of BlackRock this morning made an interesting observation. He said that existing copper mines are trading at a big discount to their replacement costs at the moment. So very interesting in the copper space. Now, it's also been, despite the relatively good commodity prices, it's been a tough time for the juniors, the junior explorers, the junior developers. Yeah. Why are they suffering so much?
Well, part of it is the capital markets are essentially broken for the juniors. We don't have the traditional funds, the resource investment funds that are supplying capital to the juniors. They're smaller, the resource funds, whether they be in Toronto, London, New York, and they're limited on the number of names. They've compressed their portfolio down to a fewer number of names, and mainly the producers. So they're looking for exposure to the commodities and maybe the best of breed discoveries, but they're not. They just don't have large portfolios to invest a lot of the juniors. We're also seeing, with the challenges in Canada, specifically raising capital, despite having the flow-through share financing and things like that, the Australians have actually come up since 2020 and met and surpassed the amount of capital that's being raised in their market versus Canada. So this is a bit unsettling for the Canadian financial system in terms of being the world leader for exploration capital.
Now, one aspect that there's been a lot of noise on lately, and that's the Save Mining Canada or Save Canadian Mining movement. They've been very vocal recently, and one of their key theses is that short selling is destroying the sector. But I suspect it's not as simple as that. Well, what's your view of what's happening there?
Yeah, I'm not necessarily buying in either. That's certainly part of it, based on the algorithms and and the trading that's frustrating a lot of juniors that haven't got a lot of liquidity to begin with. But I think there's an investor mistrust on some levels with some of the juniors not executing on their projects, having especially retail investors feeling like they're holding the bag when there's bad news, and management maybe dropping the ball. So there is an aspect of too many juniors to some extent, not enough capable management teams, and not enough stellar projects out there. So we're seeing I think a lack of trust of the sector right now.
Given the paucity of investors, we're at an event here. What's your view of the juniors that spend a lot of their shareholder money attending events in a market where there's no investors to meet with nobody writing checks? Does that show lack of imagination or even a misuse of shareholder funds?
I think if they're very targeted, that it can be important to attend some of these events selectively. If I was a junior, I'd certainly be looking for capital, and in terms of meetings where there is capital present, and even if it's 5 meetings, high quality as opposed to 20 or 30 meetings, if you're really just marketing to get the message out but not having the ability to secure capital, every junior is in a constant cycle of needing to raise money, and where there's pockets of capital, it's like our firm as well. We need to find those pockets and embrace opportunities as we find them in our sector here.
One sort of category or group of companies that does seem to be showing increasing interest in the juniors are the larger companies, some of the large gold companies, even some of the large diversifieds. What are you seeing, and why is this happening now, do you think?
Well, I think there's a real desire for the seniors to grow through greenfields discoveries and populate their pipelines with the next generation of great deposits or discoveries. And 20 years ago, the seniors really pruned their exploration teams down to a core staff. They just couldn't manage to conduct exploration globally in multiple countries and maintain a huge exploration staff. So it's a natural thing. I think that they're coming back to deploying money to the juniors to get them to do some of the early stage exploration. BHP put $100 million into Filo, which was a little bit more advanced, but it was a greenfield depth discovery there, high grade copper gold discovery. We're seeing Rio Tinto put in money not only in technology, Newton technology down in Latin America, but also in Western copper and gold in the Yukon at Casino. So they're deploying their capital to take advantage of projects that are already advanced, but also an example would be Hercules and Barrick investing in a breaking discovery in Idaho. Only 1 hole reported, I think 5 drilled. And this is, to me, a bit of a watershed moment for the sector in the terms of Barrick probably not doing a huge amount of due diligence and making a very rapid decision on a copper-only project, a little bit of silver on the fringe. But I think for them to come in that quickly probably sends a bit of a shockwave across the bow of the diversified base metal companies that typically move a little bit slower. So we'll see how that works out. But it is a fairly impressive discovery from a blind discovery almost out of nowhere in Idaho.
I think what surprised a lot of people there is I think Barrick's made 2 investments, separate investments into Hercules to date, and that contrasts greatly with, my understanding is they did several rounds of due diligence on Great Bear Resources and ended up not pulling the trigger or they were beaten to the punch by Kinross. So it seems to be maybe a very different approach. They've got to move to be able to secure things they are interested in.
I think that's probably the marching orders that Mark Bristow has given his team to get aggressive. And even though they weren't necessarily deploying strategic investments as a strategy, Mark is very nimble and able to switch gears. We've noticed that they've staked claims in Northern Ontario around a play that's going to be going as a spin-out of Northern Superior. And I think that's a product of staking claims around a play they may be interested in, before it gets heated up. And that's Great Bear, to your point. They did stake some claims in the area. They probably liked the prize, but I would say their due diligence suggested it probably wasn't a 500,000 ounce per year type production asset. And so far, it doesn't look like it's going to be.
Some of the bigger gold companies have got a mixed history of success with this kind of strategy. And I'm thinking to sort of Agnico Eagle Mines have made very strategic investments in juniors over the years. Goldcorp famously did that a lot, but I think Newmont spent much of the last few years since 2019 unpicking the investments that Goldcorp made.
Yeah, no, it's a good point. The Agnico has been quite judicious in terms of their investments, and if they get in the tent and understand the asset fairly well, and they decide to pivot and back away and sell, the market's very conditioned to that. They will come in and out, and it won't necessarily hurt the junior too badly. Whereas I think Goldcorp made some big bets, some big investments, and you know, it was a bit new for them. Agnico's been doing this for a couple of decades. And so as a strategy and their think tank and their due diligence process is fairly rigorous. Not saying Goldcorp wasn't, but I think Agnico just had a more refined process, and their batting cages where they like to make these investments were a little bit more close operations or in jurisdictions they really had ranked very, very highly.
And we have to talk about one project in a jurisdiction which you've been writing a lot about, and that's Snowline Gold in Yukon. Yeah. They've obviously got investment from B2 Gold, and I think what stood out for a lot of people there, B2 Gold doesn't really do a lot of early stage investments. It hasn't been very aggressive in M&A over the years, but when it moves, it tends to take out the company, the junior it's interested in. But this is very much, from my understanding, very much a sleeping investment, so to speak.
Yeah, we'll see. You're right. B2 Gold's only made, in my memories, I covered them from 2009 to 2019, and they invested in Matador in Newfoundland just over a year ago. That was their first one in memory. And then Snowline Gold this past early summer. I think for Snowline, this is probably an asset that they covet. They do not, you know, in my mind, see these type of opportunities very often. It's very much in keeping with open pits that are very fat, very thick, very little internal dilution, and exceptional grade, much like Fekola in a sense. So I think they realize this is a tremendous discovery. No resource yet, as you know, Paul, but you know, in our mineral inventory estimate, already 9.5 million ounces. It's in Canada, it's in the Yukon. It's probably part of a proto district, and it's exceptional grades versus the existing deposits like this, like Fort Knox or Eagle, Victoria Gold's Eagle.
It does seem that B2 Gold has adjusted its strategy for Canada because Canada is a much more competitive space. Any project there is going to elicit much more interest. When you're looking at projects in Philippines or parts of Africa or Nicaragua, you know, they can expect to have less competition, so they can wait until it's the buyout moment. But in Canada, maybe they're realizing, okay, if we want to be in Canada, we've got to get in earlier.
Yeah, I think you're bang on that they move very quickly on Snowline, opportunistically. I'm sure many companies have been to site and model up what the potential resource is after a couple of seasons of drilling. But B2, they really know what they want. They like the Yukon, as far as I know. They were up there at the Yukon Geoscience Forum amongst a few senior mining companies. This is just this past week or so. So it's again, it's probably a proto district, and the extent that this is just the first of maybe other opportunities. And we are already seeing in our research at least plus 10 million ounces of a very, very high margin situation with great metallurgy. We can see why they're on their front foot here.
Now, in general terms, if you're a junior company or an investor in a junior company, an M&A transaction is, the holy grail. It's what you're looking for. But with share prices so depressed, even if an offer comes in today with a premium, a lot of investors are going to be underwater. So I guess there's an element of be careful what you wish for at the moment. Are M&A transactions welcome in this environment because of that?
Yeah, I think it's a good point. I think there's certainly a predatory aspect of M&A that's probably frustrated investors when certain juniors have been beaten up that much, and whether it is a good thing. But a lot of juniors don't have very many options. They don't have a lot of levers to pull. Certainly a lot of fund managers I talk to want to see rational consolidation, maybe of juniors and certain belts, streamline G&A expenses, get exploration really focused on the best targets. So we like those transactions, things that can kind of augment a hub and spoke approach to projects. But the juniors really are put in a corner in this market, essentially, with the need to finance. We've talked in a number of times at various conferences that juniors need between $750,000 to $1 million Canadian just to keep lights on, just to run the company for a year. So that's a lot of capital for the amount of juniors we have globally, just to keep the lights on and comply.
A lot of management teams make a big fact in their marketing of their ownership, their own personal ownership position. The argument being that they're aligned with other investors because they own, let's say, 5% of the company. But I guess I want to touch on a couple of things here. It all depends on what price they got in, of course.
Yeah, absolutely.
And I guess this is one of the things that goes contrary to the Save Mine in Canada. One of the counter arguments is that one of the things undermining the sector is the fact that a lot of management teams and ownership teams have got 1 cent or less paper, tons and tons of it. So even
a thousandth of a cent.
So they're always in the money. And I guess the nexus of my question is, about suboptimal decision making. Because I guess you've got the contrary view that if an M&A offer comes in well below, at a very low share price, the management teams are making money, so it's good for them. Or if they have invested at market rates and they're also well underwater, they could resist a good transaction because they personally are going to suffer. Again, suboptimal decision making. Well, what's your views on this thing?
Yeah, I agree with you that the management teams, and there's a role for founder shares. There's no question about it, to give the management team a base. But the ones that have gotten a lot of cheap paper are probably they're probably willing to transact maybe ahead of shareholders' interests in some cases when an offer comes in. Many companies have got into that lifestyle mode of wanting to management teams clip a salary. The executives in the exploration square have generally been paid very, very well, and many deserve it. There's no question about it that a lot of companies do tremendous work to drive shareholder value for their shareholders. But when companies management teams have used their own money to invest and it's underwater at the time an M&A offer comes in, I think it's quite natural for management teams to feel like we can potentially do better. That's when they need good advisors, they need good independent committees on their boards who often don't own as much stock as the management team does to help navigate those decisions.
Okay, now exciting times because metals prices are high, exciting times potentially because the equity prices are low. What would you say is a healthy investment strategy for people at the moment?
Well, for me, it's the best-in-class opportunities out there, the best explorers and developers, the ones that have got great discoveries in good jurisdictions, that they're actually that have shown they can be very torquey with share price action through the drill bit. Snowline's an example of that. Hercules is an example of that. There's various plays in the gold sector, for instance, where I think you can go and get repeated good results. We cover North Isle Copper and Gold. That's one that's had great results in BC, a copper gold porphyry play, and surprise people to the upside in terms of some of the grades they're getting. So I think it's being very focused on a limited number of juniors who can actually deliver in this market. Also, commodities. There's obviously a lithium trade out there, and there's been a lot of success by the Aussies coming to Canada to raise money, especially for some of the Canadian lithium plays. The U.S. government has put a lot of money into U.S.-based lithium assets and plays. So there's still money available for the right commodity. So that's another way to look at it. The governments, both in Canada and the U.S. in particular, are going to be funding on some level infrastructure project and maybe permitting related timelines, the critical minerals. So there is a tailwind. So I would look for the best of breed rare earth element plays. We cover defense, think that is a fantastic play in BC. Nickel, which I think is kind of underappreciated, right? Some of the best plays possible in that space. And then again, back to the juniors that are having success in good jurisdictions on the precious metal side.
Okay, Michael, finally, we're on the verge of entering a new year. 2024 is just around the corner. What are some of the things you expect to see next year? And what are some of the things you would like to see next year?
Those are good questions. I expect that we're going to see a culling of some of the juniors. I think, it's been said before that a Darwinian culling sometimes is required, and I think it really is.
Will the regulator let juniors die?
It's an issue. There's no question that companies, I know the regulators want the various stock exchanges want the fees, and the regulators are very reticent to see companies die. But I think investors are going to vote with their feet and their wallets. I think we'll see fewer juniors. I think we'll see a reset. I think we'll see some optimism in the markets with a little bit more liquidity. I think some funds are doing their homework. There's new private equity deploying a lot of capital into critical minerals in particular. So I think that's what we're going to see. I think we're going to see a fairly bright start to the new year, and maybe a tick up in the gold price would help as we get into January. What I want to see is a landscape where there's a little bit more transparency. I think the analysts, in Canada in particular, been hollowed out in terms of coverage. I think we need more coverage down the food chain into the explorer developers. And so I think we need that as a capital markets entity in Canada. I think we need to see more seniors deploy strategic investments to the juniors to help them make some of these grassroots discoveries with relatively non-dilutive financings, hopefully. So I think we're going to see joint ventures too, and I think we need to see those in terms of juniors getting enough money without tremendous equity dilution, but to eventually drive projects forward and make decisions with the drill bit. So I think the seniors have a role there as well, and they'd probably rather do joint ventures, as it turns out.
Well, let's hope there are many more of those. Michael, thank you very much for joining us today.
Very good, Paul. Thank you. Appreciate it.
And this is Paul Harris for Kitco Mining at Resourcing Tomorrow in London. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of Resourcing Tomorrow is brought to you by Aris Mining.